Oh, boy. There are things in life that just need adjusting, like our spines, the volume, our attitudes, and our accounting records. We're going to work on one of those things today. And I have to tell you, I wish that we were working on Terrence's attitude. There's not much I can do there. So let's work on adjusting our accounting records instead. Welcome to Accounting How To. I'm your host, Carolyn Grimm, and that's my grumpy sidekick, Terrence. We're here to put the fun, Terrence, in accounting fundamentals. So our job today is to tackle the concept of adjusting entries. So the first thing we have to talk about is why we need to do adjusting entries. So when we talked about journal entries in general, we said that an adjusting entry is not a correcting entry. It's not that we're correcting a mistake that we've made. An adjusting entry is done because there are accounts that have balances that are no longer accurate. We'll get into some specifics here in a moment. So when we use the accrual basis rather than cash basis as our method of accounting, we have some extra things to track. Now, if you haven't seen the cash versus accrual basis video, I'll link that up in the corner. But under accrual accounting, we need to make sure that we are recognizing our revenue when we earn it. And we need to make sure that we are recognizing our expenses in the month of that revenue, the matching principle. So we want to make sure that our expenses end up with the revenue that generated those expenses because it takes money to make money, right? So we do adjusting entries once a month on the last day of the month. Now, we don't have to do them on the last day of the month, but they need to be dated on the last day of the month. And the reason for that is it makes it really easy for us if we've got to go back and answer a question or we need to make a change to a journal entry. We know that those adjusting entries are always going to be the last day of the month, and we do them after we have taken care of all the other regular entries for that month. So what kinds of adjusting entries do we need to do? What kind of accounts are going to be impacted by this? Well, we're going to be impacting both balance sheet accounts and income statement accounts. So balance sheet accounts, as you remember, are assets, liabilities, and equity. And our income statement accounts are revenue and expenses. So we're going to be impacting a balance sheet account and an income statement account in every adjusting journal that we do. Now, within the accounts that we already have, that we've already been talking about, we now need to add on some new account names. So here's your rule of thumb. As we're adding these accounts, if you see an account that has prepaid something, that account is going to be an asset. So the account type is an asset, has a normal debit balance, so we increase it on the debit side, decrease it on the credit side. Nothing has changed here. So anytime you see something prepaid, whether it's prepaid expense, prepaid insurance, prepaid rent, if it says prepaid, it is an asset. The other new account that we're going to run into would have unearned in its name. So unearned revenue, unearned rent. If it says unearned, then the type of account is a liability. A liability has a normal credit balance, so it's going to increase on the credit side and decrease on the debit side. So anytime you see something called unearned, it is a liability. Now, every prepaid account, every prepaid asset has an associated expense account. For example, prepaid insurance has an associated account called insurance expense. When we had supplies that we then moved over to our expense account, we had supplies, the asset, and we had supplies expense. If we have prepaid rent, we're also going to have rent expense. So every prepaid asset account is going to have an associated expense account. Now, on the unearned side of things, unearned revenue, unearned rent, we're going to have a revenue account that goes with those. So the unearned part is a liability and then we have an associated revenue account to go with that. So unearned revenue, revenue, unearned rent, rent revenue. And the job of our adjusting entries is to move things between those accounts. So we're moving things from prepaid insurance to insurance expense. We're moving things from unearned revenue into revenue. That's what adjusting entries are going to do for us. And as I mentioned, every adjusting entry has one income statement account and one balance sheet account. So if we're moving from unearned revenue, a liability, we're then going to be moving into revenue, which is an income statement account. Now, one thing that you should never, 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 never put into an adjusting entry is cash. So there should never be an adjusting entry ever that involves cash. Because think about that. Can you just adjust your cash? I mean, if you could do an adjusting entry to adjust cash, I would be doing that all day long. Adjust my cash, debit that thing like crazy. Come on. So no cash in adjusting entries is what I'm saying. And I want you to understand I'm saying there is no cash ever in an adjusting entry. Okay? I say that like 50 times in my accounting classes. Every single time somebody will debit or credit cash. Oh. Ugh. So the key to understanding what needs to be adjusted is to know the history of the transaction. So let's go through some of those. Let's say that we've contracted with a customer. We're going to do a project for them. And part of what we require is that they give us a deposit. So our customer gives us a $500 deposit, and we're going to do the work next month. So based on the revenue recognition principle, we can't claim that income yet because we haven't earned it. We can only claim revenue when we have earned it. So what happens in that original transaction? Well, we're going to increase our cash, $500, we're going to debit it, and then we're going to increase this account called unearned revenue by $500. It's a liability, normal credit balance, increase on the credit side. So what happens if we don't do this job for this customer? We got to give the money back, right? So it is a liability. We owe that money to the customer until we do the work. So the original transaction is going to be a debit to cash and a credit to unearned revenue. Well, when we actually do the work, now what we've got to do is we've got to move it out of unearned revenue and into revenue. So we're going to do that by debiting unearned revenue to decrease it and increasing our revenue by crediting it. So when you think about adjusting journal entries, think about what the original transaction was. You're not starting at the beginning when you're doing an adjusting entry. You're coming in later on. So keep that in mind as you're looking at adjusting entries. What was the first thing that happened? What happened with those accounts? And now how do you need to adjust them to make them be the correct balance once you have done the work? Let's look at another situation. Let's say that on January 1st, you pay 1 year's insurance premium for $1,200. Now, you're not going to claim this as an expense in January because it's for the whole year. So you want to split that up over 12 months. So every month you're going to do one entry for 1 month's insurance. So what happens in the original transaction? Well, we've got this asset, just like accounts receivable has value, a prepaid asset has value, right? If we cancel our insurance policy, we get that money back. So until we use it up over that 12-month period, it has value, so it sits on the balance sheet as an asset. So in the original transaction, we are going to debit this asset called prepaid insurance, and we're going to credit cash because that's how we paid for it. We wrote a check. So then at the end of January, the first month has passed. We have used up 1 month's worth of insurance. So we're going to reduce that asset by crediting it $100. And the other side of that is going to be a debit to insurance expense. So as we use up that asset, it becomes an expense. We're moving from the balance sheet over to the income statement. Now, usually when we explain adjusting entries, we split them up into accruals and deferrals. But for me, it makes more sense if we look at revenues and expenses, and then we look at accruals and deferrals below that. So let me see if I can explain that. So our revenue-related transactions may be accruals or deferrals. Our expense transactions may be accruals or deferrals. Well, what does that mean? What's accrual and deferral? What is this language I'm speaking here? So in accounting, an accrual means that cash comes after the transaction. So you sell to a customer on account, or you buy from a supplier on account. So you sell the thing to your customer, but you haven't gotten the cash yet, right? So it's an accounts receivable. Or you buy something from your vendor and you're going to pay later. So an accounts payable. So an accrual means that cash comes after. And you can remember that because accrual and after both start with an A. So a deferral means that cash comes before the transaction. So unearned revenue, we got that deposit from our customer. We got the cash first. And with our prepaid expenses, our prepaid insurance, our prepaid rent, we are paying before the transaction, before we actually are using that insurance up. So accrual, the cash comes after, and deferrals, the cash comes before. So under the revenue side of things, we could get cash before the transaction, a deferral, or we could get cash after, accounts receivable. On the expense side, we could be paying later because we bought it on account. That would be an accrual, cash comes after, or we could be prepaying, a deferral. The cash comes before the transaction. So we're going to get into those in depth in 2 other videos. I'm going to split out the revenue and the expense adjusting entries so that we can really go in deep on each one of those and understand them better. So in our next videos, we'll get deeper into the revenue side and the expense side. And we'll go through the typical transactions that you would see, both the beginning transaction and then the adjusting entry that goes along with them. So join me in the next video. Until then, stay balanced, my friends.